Welcome to Annuity News Now. If you're unsure about how to invest your retirement assets these days, the professionals who do this for a living share your pain. Low interest rates make finding safe returns sometimes very difficult. My guest is America's retirement strategist. He is retirement expert Bill Losey. Bill, welcome.
Oh, my pleasure to be here.
Yeah, so we're talking about an environment of low interest rates, which makes it difficult for everybody. I mean, a lot of people years ago, they'd put money into a CD and they could take out their 4% and their principal would be safe. And you have insurance products like annuities, which are a little bit different, but they're sometimes a little bit hard to handle in a low interest rate environment. How is all this changing the way that you do business these days?
Well, I think the way that it's changing business is that, back in the good old days, and by good old days, I'm talking just 5 years ago,
right.
It was a lot simpler because this was, before the Great Recession, and, you were able to go ahead and, pick and choose certain investments, and you would hold them long term, and you really wouldn't give it too much thought. I mean, at least it'd be a 5-year holding period. What I'm finding now is that with the rates so low and so much volatility and just so much headline news, especially coming out of Europe, people are having a hard time even wanting to hold investments for 5 weeks, let alone 5 months or 5 years. So I think what's happening now is that there's a lot more behavioral finance and counseling and education that's actually going into the retirement planning process because, the number one fear today, it's still the same as it was years ago. I mean, people are afraid of running out of money, and nowadays, when you hear about companies going out of business and big companies like Lehman Brothers, et cetera, going out of business a number of years ago, people want to make sure that if they're putting their money in a CD, or in an annuity, that that the bank and the insurance company are going to be around.
Right, and then and you're talking about, for example, CDs now, which are paying about 0.5%. Talk about those particular clients or retirees who are really risk averse right now, but there's really no place that they can go that they can think of that keeps up with inflation.
Yeah, well, I actually think that the popular media does not give American consumers justice. I think that the media thinks that consumers are really dumb and stupid, and they're not. 4 or 5 years ago, you could put your money in a bank money market, for example, and you could earn 4 or 5%, or in a CD earning 4 or 5 or 6%. And now, like you said, most of them are well under 1%. The bottom line is that people now recognize that that it's not just about maintaining their principal, but what's most important is that they maintain their purchasing power. Mm-hmm. So with my small client base, for example, I have people that used to have money or a portion of their money in some CDs, and now they're actually venturing out into other sort of fixed income products, different bonds, individual bonds, and/or bond funds, anywhere where they can get a higher yield. Now they understand that there's risk that goes along with that. But certainly, living on 0.5% is just not going to cut it. So, so these people are now, being forced to and recognizing they need to take at least a little bit of risk with their money in order to earn that higher yield.
Mm-hmm. And so, when you look at the long term here, and we don't anticipate interest rates to start rising anytime soon, what are some of the other options that you consider now for those people again who are looking for safety and are probably living a lot longer than they thought they were going to live?
Yeah, well, the bottom line is, I'm talking through lots of different strategies with my clients, and a lot of the strategies actually are not investment strategies. They're more life strategies. So, for example, it could be that, because interest rates are so low, you want to continue to work another year or 2 or 3, to continue to bank money, to offset, what that, potential decline in income from low rates may be. So that's one strategy. Another strategy may be that, if you are at the point where you're retiring, my happiest clients are those that have actually downsized and simplified. So I have clients that, for example, are relocating out of New York or New Jersey, which are some of the highest tax states in the entire country, and are moving to states like Florida or to Nevada, for example, where there's no state income tax. And those areas have also been hit really hard by the real estate crisis. So, people, are now picking up houses, that are, 40, 50, 60% less than they were just 5 years ago. So to the extent that people can downsize and simplify their life, that's freeing up cash flow, and it's taking the pressure off of them having to take riskier bets with their investments.
Would it be safe to say that a lot of people will probably have to rely a little bit more, if not a lot more, on Social Security, and maybe these people don't really understand how to use it?
I would say that that's a definite possibility. I mean, one of the most popular questions I get asked is about Social Security, and it's, should I take it at 62 or later?
Mm-hmm.
I think the big concern here, especially for those folks that are now approaching Social Security age, is the fact that, just within like the past 30 to 60 days, a report came out that talked about how it's going to be underfunded, much closer than it is now. To the extent that maybe in another 15 or 20 years, it's only going to be able to provide about 70% of the benefit that's stated on your personal earnings and benefit statement. So there again, it's like, you have a low-rate environment, you've got Social Security, running out and or only providing a portion of the benefits that they were promised to you. And I think that's where, people are finally understanding that they need to take matters into their own hands. And there's only so much you can control. It's like, can I work longer? Can I earn an income? Can I save more? Can I spend less? And to the extent that people control those things, they're going to put themselves in a much better position to be able to retire.
Mm-hmm. Let's go back to something that you said, I think, in the beginning. There's a lot of market volatility right now.
Yeah.
Is buy and hold still a good idea for people?
That sort of goes back to what I was saying about the whole thing about, planning long term. It's like,
right.
Back in the good old days, you'd try to invest for 5, 10, 15 years, and
right.
now people are having a hard time 5 months down the road. I personally do not believe that buy and hold is dead, although it's taking a lot more hand-holding in order to keep people in their existing investments. Because there's a ton of research out there, Scott, that actually shows that, that people who trade often don't do as well as buy and hold investors, and there's plenty of research to show that people are always, buying at the top and selling at the bottom.
Mm-hmm.
The fact of the matter is, virtually all of my clients, held on to their investments all through the, late 2008, early 2009 decline, and after a great first quarter, everybody's, now at new high watermarks, on their investment portfolios. But I think that the one main way having to liquidate and panic your portfolio is to really sort of have a buckets of money sort of system.
Mm-hmm.
So for my clients, most of them who do not have pensions and are relying solely on Social Security and their investment portfolio have anywhere from 2 to 5 years worth of expected income needs already set aside in safe money sources like a CD or a money market or a treasury bond or a fixed annuity or an immediate annuity or even a fixed indexed annuity.
Mm-hmm.
So people understand that they're not going to earn a lot of interest on that portion of the portfolio, but that's not what the goal of that portion is. That portion of the goal is to replace the income that they used to make when they were actually working.
Mm-hmm. This is Annuity News Now, and we try and educate people on these kinds of products. Can you talk a little bit about, again, with the low interest rate environment in mind, how annuity products can provide some help with taxes and inflation and the low interest rate environment, and maybe some options that people might want to find out a little bit more about?
Yeah, well, I tell you, years ago I was very skeptical of annuities, and I'm an independent registered investment advisor based out of New York. But my eyes really, opened up, and my brain opened up because I realized that, in order to help my clients, I needed to really think more outside of the box. One of the more popular products, with my clients for at least a portion of their investment portfolios are these fixed indexed annuity products. And over the last 7 years that my clients have held them, they pretty much average somewhere between 5 to 6%. They were fortunate enough, to lock in, guaranteed rates of at least 3%, which was great because they wanted some stability of principal. But more importantly, because of the index portion of the annuity contract, they understood that, it's really important that they not only protect their principal, but they have something that's going to keep pace or outpace inflation. And that's where these products come in. So, for somebody that's, a saver, typically in the bank or in the CD, these are a really good option because they give you an interest rate typically a little bit better than the bank, but they also give you the option to make a little bit more, with not a whole heck of a lot of downside risk. Because all the contracts guarantee at least some base minimum rate.
Right. Then in closing here, you did mention that you thought, consumers have gotten a lot more savvy on investment. products, planning for the future in retirement. But there's still, there's still some education that needs to happen when you're talking about things like annuities, when you're talking about taxes. It's probably still a good idea to have some sort of professional help, isn't it?
Well, the bottom line is, research that I've seen, inside and outside the industry usually indicates that people that are the best prepared are those that actually have a long-term relationship with some sort of financial advisor, financial consultant, or certified financial planner. But when I talk about, my rules for saving for retirement, what I refer to as the most important rule is this, is that the government and your company are not going to take care of you. So it's really important that people read, listen, learn about personal finance, investing, annuities, and strategies, because in the end, their financial well-being, it's their personal responsibility.
Bill Losey is my guest. He's in New York, and he is a retirement expert. He's also been called the America's Retirement Strategist. Bill, it is a great pleasure. Thanks for sharing your time today.
Oh, anytime, Scott.
I'm Scott Drake, and you're watching Annuity News Now.